Welcome, everybody. It is a snowy day here in Utah, and all of us are hopefully staying home today. And over the last just week, I've had a couple of real estate agents reach out to me and ask about assumable loans. One has a buyer that wants to buy a house that has an FHA loan on it, and the other one is a listing agent that their seller has been approached, and they want to know what it takes to do an assumable loan. And there's some really kind of interesting, I don't know if tricky is the right word, but some very, very vague things about this. So we've done a little bit of research, and even though we don't actually help the client do it, it doesn't go through a mortgage company like us, we want to provide that information for people. And so I'm going to go ahead, I'm going to mute everybody but Tyson and I. Let me just...
Looks like everyone is.
Okay, wonderful. All right, here we go. So Tyson and I are going to kind of share what we do know about it and how you can help your clients, whether they be buyers or sellers. Use the chat box if you have questions, and Tyson and I will keep an eye on that because we do want this to be a Q&A, okay? So what types of loans are assumable? It is only government loans. So that would be FHA, VA, and USDA. So right now, at least 2/3 of all mortgages are conventional. So Fannie and Freddie loans, those are not assumable. So if the seller has a conventional loan, this is not even an option, right? So if they have an FHA, a VA, or a USDA loan, then it can be assumable. Now, why would someone want to do this? Well, I have some clients that we closed back in 2020, 2021 that have interest rates in the 2s and in the 3s. And so obviously right now we are in the 6s. It makes a whole lot of sense to assume a loan that's at 2.5% or 3%, right? The tricky part is that they're actually difficult to get done. So we're going to tell you a couple stories about that, right? So first of all, let's talk about the process of it. It really puts a lot of the information gathering responsibility to the seller, because as an agent, you can't do it. As a mortgage lender, I can't do it. Every servicing company has different rules. And so your seller, the seller of the property that has the loan that's assumable, needs to call their servicing company and get information on what it takes to assume that loan. So here's the questions they're going to want to ask. They're going to want to ask, how long does it take? And I'll tell you right now, add a couple weeks to whatever they say, because they're taking a very, very long time. What is the process? What paperwork do I as a seller need to do? What are the requirements for me? And what does the buyer need to do? Because all buyers on assumable loans have to qualify for the new loan. So they have to have debt to income ratios in line. They have to have decent credit scores. And credit scores actually can go down to about 580 to 600, and they can still do an assumable loan. So it's pretty low, and they can still do it, right? And so they really need to ask those questions and gather the necessary paperwork and documentation to get the ball rolling. Okay, so that's the responsibility on the seller. So now let's talk about the buyer. So like I said, they need to qualify, but here's where it gets tricky. We're going to take a very round number of a sales price of $500,000. Okay, the seller owes $300,000. How on earth can the buyer come up with the difference between $300,000 and $500,000? So this is one of the big obstacles of that. So there are second mortgages out there that the buyer can get, but most of them right now are limited to 80% combined loan to value. So basically that means you can only go up to $400,000 with the first and the second. So the first mortgage that they're assuming is $300,000. They're going to have to get a second mortgage for $100,000. They're still going to be short $100,000. So buyers, where are they going to come up with the money, right? This is a situation where you're really going to want to think outside the box. You're going to say, do you have a family member that could gift you the money? Do you have resources through your 401k that you can borrow against? Do you have a family member that has equity in their home that they could do a line of credit with and you pay them back, right? So I like to throw lots of ideas out there to give people the opportunity to really think through every option that they might have. In the end, this is probably the largest obstacle that your buyers are going to run into, is how do they come up with that gap? I know right now most credit unions are offering second mortgages, but what I don't really know is how they do it when it's to purchase a home, right? But I do know the interest rates are really high on them right now. I personally have a line of credit and my interest rate just went up to 8.5% on it. So they're really high. So when you combine all of that, in the end, the dust might settle and it might be better for them just to get their own first mortgage anyways. But it's definitely worth doing the research on it, because as agents, I know you guys are getting a lot of people asking about that. So the more knowledge you have, the better. So a couple of stories. Tyson, why don't you go ahead and share your VA experience that your client's going through right now?
Yeah. So I just looked up the text messages between us, and so his situation is his parents have a VA loan on a house they want to sell to him, and September 27th was the first time we started talking, and he started asking me about things like that. And we went through some different options, but at the end of the day, he was going to try and assume that loan. So he's not a veteran, but non-veterans, in my research, this is kind of fuzzy too, but it sounds like in some cases, non-veterans can assume a VA loan. And I texted him on February 6th and asked if it was going to work out. And he said he was supposed to hear an answer soon. And then I texted him today before this meeting and haven't heard back. But that's like 5 months into this process of going through everything. So at the end of the day, I really hope this works out for him, because it's been so long, and I would hope they could say, no, it's not going to work before they spend 5 months doing it. But yeah, it takes a long time. So if your seller needs to get rid of a house before 4 to 5 months, then this probably isn't an avenue to go down.
Yeah, that's true. And I also found in my research that on VA assumptions, they do charge a 0.5% origination, or I'm sorry, funding fee. So again, if it's a $500,000 loan that they're assuming, they're going to have a fee of $2,500. But that actually brings up the topic of what does it cost? And this is, I think, directly related to why some servicers are currently choosing not to do assumptions and why other ones are taking 4 to 6 months. So it's federally mandated right now that the most they can charge is $900. The minimum cost to a servicing company to do an assumption is $2,500. So they're basically losing money every time they do an assumption, which is probably why they are giving so few resources to this process, is because they can't afford to, right? Mortgage companies in general are bleeding money right now because the market has shifted so drastically. So another story time. So we have someone in our office that has a past client that was wanted to assume a loan. And again, we don't do that for them, but this loan officer said, hey, I'll help you with it. I'm interested in the process. Let's see how it goes. I'll help you do it. So that was probably, I think, last August that they started the process. And they were told, yes, you can do this. Here's the paperwork. They submitted the paperwork 3 times. And then on January 3rd, they were told that they were no longer doing any assumptions and shut the file down. So they strung them along. And then they said, as of January 3rd, we're no longer doing assumptions. So it didn't even get finished. So the reward is great. If you can make it work, being able to assume a loan at that kind of an interest rate is really a great financial thing. But everybody needs to go into it with their eyes wide open, that it's not a quick process. And in some cases, some servicing companies are saying, we're not going to do it. We can't afford to do it. And so those are kind of the risks involved with that. Let me look at my notes and just see. Appraisals are not required, so that's kind of a nice thing on that. Of course, if your buyer is getting a second mortgage to cover some of the gap, then they may require an appraisal. But the actual assumption does not require an appraisal. And right now there is a push in the industry. Honestly, some of the articles I read, there are some advocates trying to make it so that one, servicing companies can charge more money. Obviously, you need to make money. And so if they're allowed to charge a little bit more, they have an incentive then to do assumptions. Right now, there's no incentive. It's the opposite of an incentive. If I can only charge $900 and it costs me a minimum of $2,500 to do this, why should I do it? And so I really do hope that there are some more advocates that step in and push for that, because that has to change at a government level for that change to happen. So that would be huge, right? And as a buyer, if I was going to assume a 2.5% rate, obviously I'd be willing to pay 2% to do that, because it's going to cost me at least 2% to go get a new mortgage at 6.5%, right? 2% in fees. And so it makes a lot of sense to be able to do that. The other things that advocates are pushing for is to get more investors and lenders out that are willing to do that gap financing, right? Remember, we had the example of a $500,000 sales price, a $300,000 assumable mortgage. Where does the $200,000 come from? And so that gap needs to be addressed, and there needs to be more resources. The problem is that all financing has been shrinking, right? Because as interest rates go up, then risk goes up and financing shrinks. And so I just think that it's going to be very interesting over the next 6 to 12 months, because we're in this interest rate environment for another 6 to 12 months. It'll be interesting to see if there are some changes that make it a little bit easier. And then honestly, I think that probably between 2024 to 2025, we're going to see rates go back into the 4s. I don't think they'll get any lower than that. But if we're in the 4s, those assumable loans aren't as attractive anymore, right? Because appreciation keeps happening and that gap keeps getting bigger. But realistically, as agents, we've got another 12 months where you're going to get questions about this. You might have a buyer that says, hey, I only want to look at assumable loans or houses that have assumable loans because I want that interest rate. Well, you can then educate them on what that means and the risk it takes. If you are a listing agent and you have sellers that have an assumable loan, have them, when you do the listing, have them do the research up front so they know that if it's even an option and what the process is and what the time frame is. So then you can provide that information right away. Tyson, do you have any questions on that?
No, I don't think so. I think that's been pretty thorough. Just I've been looking at the chat.
Okay.
And a couple people, well, Pam wanted to know if the funding fee was on the purchase price or the loan amount, and that's on the
Loan amount.
And then Brian asked if we've heard of anyone actually making it work. I haven't yet, and I don't think you have either, right, Liz?
Sadly, no. And I actually did a little bit of research this morning, trying to find some more information. And realistically, everything I just told you is what I found this morning. Or what I didn't find any additional information is what I mean. So I was really surprised because it is a hot topic right now. So I think we'll get more information as time goes on and see hopefully some success stories. But right now, sadly, no.
Yeah. I've had a couple of people, the one I mentioned, and then and then a couple others inquire about it, but hasn't really gone anywhere.
Mm-hmm. Yeah.
Okay, and then Shauna and Wendell were kind of asking about that 20% gap, right? If you can only get a home equity loan or something up to 80% loan to value. And so, it's just a risk thing, and that's pretty common on like a cash out refinance. It's the same thing. You can only go up to 80% loan to value.
Well, I think servicers and other lenders there, you might be able to find one that goes to 90% combined loan to value, but it's a really high risk to them to be in second place. And so that's going to, so here's the hard thing. You're going to need the seller to do research on the assumption. The buyer is going to have to do research on where do I come up with that gap money, right? And so I personally would absolutely love if anybody has someone going through this process, give us feedback. Let us know where they got gap financing, how it worked for them, how long the assumption took, so that we can share that information, because obviously knowledge is power, right? And right now we don't have a lot of people that have fulfilled these type of transactions to be able to even tell us how it's going, right? We can give the facts that we know. I think the most shocking one that we have is that they can only charge $900. It costs them at least $2,500. So why on earth would a servicer put more of their employees to this? Why would they can even continue to do it if they're not going to make any money, right? I think some will, but I think unless that changes, you're probably going to have more servicers basically say, peace out. We're not doing it. We can't afford to do it. And so that research up front is going to be critical.
Yeah. And just to add a little more detail on the kind of the gap financing thing, because what Bliss said is, and I don't know if you guys all know this, but liens are recorded in order. So the primary mortgage would be in first place, and any secondary financing would be in second place, which means if that home went into foreclosure, the first mortgage is paid off first. And if there's nothing left to pay off the second mortgage, then they just don't get paid. So that's why there's a risk.
And that's why back in 2008, most second mortgages completely lost out, right? And so they're very, very risk averse. And that's why second mortgage interest rates are always higher, because it is a higher risk. And so you can go and go into foreclosure, and that first mortgage servicing, they will basically try to sell the house for what you owe on it for the first mortgage. They just want to get done, right? They lose so much money on foreclosures. And so super high risk to be in second position, especially where people are nervous about the market possibly going down in value, which in Utah, I don't think that's going to happen. I really don't. But servicers, second mortgage lien holders, they look at it on a national level. They don't look at our little micro economy right here that's really still very, very strong. So cool. Any other thoughts, Tyson's, or any other questions from anybody else?
No, I think it's good on my end. I know this might sound like kind of a downer Zoom call, because yeah, we haven't heard anyone make it happen, but I think it's really valuable that if you do have a seller that wants to list and advertise that, it's probably not a good idea. Like I would not encourage any agent to put that in the listing, that it's an assumable mortgage. I mean, technically it is, but you'd want to do
you had enough information.
Yeah, you've got to do your homework.
Information about what it took, and your sellers have the ability to wait.
Yeah.
Well, and here's maybe a glimmer of hope, right? The bright side about it. You may be able to sell the house for a higher loan amount. I'm sorry, a higher sales price to an assumable buyer, because you're willing to wait for them to get the assumption. They may be willing to pay top dollar for that house to get that 3% rate. So it's just information for you to be able to relay to your buyers and sellers, so that really you become that trusted resource to them. And especially if you're doing listing presentations against other agents and you go in with this information, just think about how that sets you apart from other agents that are presenting to that seller, right? You've already done the homework. You're saying, here, this is what you need to do if you want to do this. Here's why I maybe think it's not a great idea, but let's do the research. It just puts you in that position of a trusted resource that is really critical when you're competing against other realtors. So I have a realtor that I recommended one of my past clients to, and I knew they were talking to two other realtors. One was a family friend or relative that had only been in the business 6 months, but was a go-getter. And then the other realtor had been recommended by a coworker, and had been in the business quite a while, but they didn't know him very well. So luckily, my agent that I referred to them actually got the listing. And it really came down to, because when I first talked to my clients, they're like, yeah, we just don't know who we're going to go through. We're meeting with all three and we just don't know what we're going to do. And so when they decided to use my recommendation, their response to me was, she came across as so knowledgeable about this market and how we should price our house and what's happening with interest rate and how that's affecting this and listing our house, that we just felt like she was the one that we could trust. And so yeah, that's kind of just why I wanted to give you guys this information, is to give you that tool. Awesome. Any other questions, guys?
I have a question.
Yeah, Shauna.
So you said the $900 versus the $2,500. Is there any way for the client to bridge that gap? Like, is there a way to approach the lender and say, or is that inappropriate? I don't know.
Well, here's the thing. I just don't think they're allowed to charge
Take
more
any.
than $900.
So there's no way that they could take it out of another part of
No,
the.
they just, and it's really bizarre to me. This is, free market economy, right? Shouldn't we be? Yeah.
Right.
So that's something that I tried to get more information on, but I literally couldn't find it. And
Okay.
so, but I do think that's the roadblock to why these are so difficult and take so long. And some are absolutely just choosing not to. Yeah. I wish I could slip someone some money under the table.
Well, even if they just charge it as a lender's fee, I
Right.
don't know. Is that possible?
Buyers, you can't. Yeah. Buyers absolutely would be willing to pay it right now.
Right. Right.
So yeah.
Okay.
Oh,
Thank you.
Pam asked a great question. Why does it cost $2,500? So there's a lot of administration personnel cost to doing an assumption. So you just have salaries and paperwork and departments, right? If you have an assumption department, you have to have the money to pay for those people. And if assumptions are losing money, why would you have very many people in that department? Right? You're going to put your money and your resources, personnel resources, into departments that are making money. So yeah, so that's it. All right. Well, guys, we're going to have the recording. If you want to share it with any of your sellers, if they have questions on it, you're even welcome to do that. And really appreciate you guys being on this call in this snowy day.
Thank you.
All right, guys. Thanks so much.
Bye-bye.